Unit-linked insurance policies or ULIPs have costs and charges under various heads. Make sure that you know what they are before buying the policy. If you have an insurance agent, ensure that he explains them to you. You can also find them in the benefit illustration of your insurance policy. Some insurance policies will either waive the charges or refund them after a certain number of years. While a waiver is undoubtedly a positive thing, a refund is not quite the same. Paying back your 100 rupees after 10 years is a much lower sum than paying your 100 rupees back now. So is there a cap on these charges? The IRDA prescribes something called maximum reduction in yield. So if the pre-charge yield that you have got from the policy is 10%, then the maximum post-charge yield can be no lower than 7%. To be precise, the IRDA prescribes the maximum reduction in yield at 3% for policies of a term of 10 years or less, and a maximum reduction in yield of 2.25% for policies of a greater term. But there is one flaw. This reduction does not include mortality charges, and these charges can cause your net return to be far lower than even this maximum reduction in yield cap. So therefore, unlike mutual funds, ULIP charges are neither transparent nor bundled into a single figure like an expense ratio. In case of traditional bundled plans, even this detailed breakup is not there. So what are the ULIP costs and charges? To begin with, there's premium allocation charge. As the name suggests, this charge is levied for allocating the premium between the different ULIP funds. It is therefore collected before any money is invested in a ULIP fund. Then there is policy administration charge, which again, as the name suggests, is taken for administering the policy, and it is imposed by cancelling your units in the policy. Then there is fund management charge. This is the closest figure you can find to the expense ratio of a mutual fund. The IRDA has capped this charge at 1.35%. Then there is mortality charge. This charge is levied on the insurance component of your policy and varies according to your age. At higher ages, it can absolutely decimate your returns. For more information, read this article by Deepthi Bhaskaran. Apart from these charges, the ULIP gives you a certain number of flexibilities, and these flexibilities also come with charges. First, there is premium redirection charge. In this charge, you can redirect your future premiums from one ULIP fund to another, and that carries a cost, which is the premium redirection charge. Then there is the fund switching charge. Once again, you can switch your money from one ULIP fund to another, but this also can carry a charge called the fund switching charge. Then there is partial withdrawal charge. This charge, as the name suggests, is levied on withdrawals from your ULIP fund. Some ULIPs will allow partial withdrawals up to a certain amount and up to a certain time period. Finally, there is surrender charge. This charge is levied if you surrender the policy before maturity. In case of traditional bundled plans, this charge can eat up your entire premium in the first 1 or 2 years and take a huge chunk of it even thereafter. In case of ULIPs, this charge is capped at Rs 6,000 in the first year and then keeps decreasing every year subsequently and is not imposed after the 5th year. However, surrendering a ULIP before 5 years will move your money to the discontinued policy fund, and you will not be able to access it at the time of surrender. Products such as ULIPs mix insurance with investment and often end up giving you the worst of both worlds. But if you still want to go ahead with the ULIP, it's important that you understand the costs and charges involved.